What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome. Okay, guys, Jay Martin here, CEO of Cambridge House. And it is my honor to sit down with the legend Peter Grandich, who was the author of the Grandich Letter for 30 years, from 1984 through to 2014. Author of Confessions of a Wall Street Whiz Kid, which ended up having 4 editions. And a speaker at the Cambridge House conferences for, we were just chatting about this, probably 20 years. Peter, it's great to see you. It's great to have you on the show. It's a true honor.
Well, the honor is really mine, Jay. Your dad and Cambridge House were a very, very important part of my life. The 25 years I spent in the metals, and to see how well you've done and what you've taken to the level you've taken to, I'm as honored to be here as you claim to be honored to be speaking to me.
Yeah, we have a lot of fun. It's a ton of fun we get to do. You know, at the end of the day, Peter, I'm an investor, as I said, and I'm just looking for the smartest home for my cash. And I'm happy to be able to do diligence and whatnot live on the channel. It's a real privilege. So, I know a lot about your background, Peter. I know where you came from. I know about your track record on Wall Street. I mean, you're one of the few guys that predicted the 1987 crash. I think maybe that's what earned you the moniker Wall Street Whiz Kid back in the day. You since converted that into a few books, authored the Grandich Letter, as I said. But, what are you up to these days? What occupies your time? I'm seeing you're very active on Twitter and doing a ton of podcasts and shows. And I was so pleased when you appeared back on my radar. So get us up to date. What is Peter Grandich up to today?
Sure. So while I was working first as a money manager, and then in the mid-90s switched over to the corporate communications consulting end, I simultaneously got involved with working with professional athletes here in the United States, and primarily New York area, Philadelphia sports teams. In fact, I spent 13 years doing Bible study in chapel with the Giants. So for 20 of those years, up until late last year, a primary part of my business, especially after leaving the metals industry in 2013, was working with athletes to a specialized financial planning group. But because of what happened in sports and how players took a side of something that my faith wouldn't allow me to do, I chose to close that business and gave up a fair amount of livelihood from that. And now really just do business development for the planning group. I comment on Twitter. I guess the pandemic brought me to it. It wasn't something I ever imagined I'd be doing, but suddenly I found myself in front of the computer and wanted to share my thoughts. And the only other thing now, really in the twilight of my career, as I approach age 65, is I became very involved in a farm that not only helps foster animals, but also helps special needs kids and all. And my wife and I are deeply involved in that. So that's pretty well much where Peter Grandich ended up. But he still has a great love for the metals and mining, and still takes a look at the markets in general.
Yeah, I know you're active in the markets because I see your commentary, mainly on Twitter. And, it's why I wanted to chat with you, Peter, because, you've got a lot of perspective that I don't have and a lot of my audience doesn't have, just given the fact that you've been through so many ups and downs, bulls and bear markets in the metal sector. And so, why don't we start here? There's more noise and call it pollution in our news feeds than ever before. More distractions, more day over day volatility. So, as somebody who's weathered so many storms in the metals business, Peter, what are you focused on right now when you're looking at the precious metal sector, and how can we differentiate between the noise and the signal?
Sure, Jay. Well, actually, after I left working in the industry, I basically left following and investing in the metals until 2018, when, despite what my wife had to say, I switched out of our general portfolio and went into all gold and mining stocks. And that was kind of crazy at the time, but it did well. And then last year, before we reached the high, I kind of got out, been back and forth, but I'm really following 3 themes. At this point in time, you're correct. We're certainly at an extremely crossroads in the markets. there's very hard to find justifiable reasons to want to start a general equity portfolio now. If you haven't had one, I really think, the ferry has sailed. Wait a few years, and because I think you'd be taking a lot of risk of principal loss. But I think there's areas still that warrant attention. One is obviously, as you mentioned, gold and silver, to me, are still an attractive place. I don't think we've come close. We may be in the fourth or fifth inning of a 9-inning game. Last year, in all the years of being around the metals, I invested in a metal aggressively that I never even touched or listened to much about, and that was uranium. And I've been called a uranium bug in the last year because probably have more post on Twitter about uranium than any other single factor. And lately, I've become very interested in what will be the electrifying of the world. I probably won't be around to see the full amount of it because they say it's going to take 20 or 30 years, but it's clear and evident that if we're going to have electrical cars and all the other stuff and clean air and all the things, not only will nuclear energy play a role, but electricity in general is going to double in usage. And if it's going to double in usages, there's going to be things that are going to need to support it, like copper, aluminum, other metals that play an important role. So irregardless of whether the stock market is peaked or going up another 20% or about to fall 30%, I think I will continue to maintain an interest in those three areas because I see them withstanding anything other than a crash. If crashes come, liquidity is essential. And so uranium stocks will not somehow stand up because they're just uranium stocks. They'll probably rebound a lot faster. But outside of a crash, I think those three areas, I'm not too worried about a loss of principal that I would have in general equities or like bonds now. I think one of the worst investments anybody could make right now is investing at 1 or 2% for something for 10 or 20 years when we already know inflation's double of that and it's going to be going a lot higher because we have a new commodities bull market. So avoid bonds at all costs. If you aren't in the general equity market by now, maybe it's a good time to stand aside and try to focus on some areas that you think have special upside. And I've mentioned the three that I believe in.
Right. Now, I'm with you in that market crash scenario. There's just a flight typically to US dollars, and that's unavoidable. Everything drops out of sympathy. Talk to me about your portfolio, Peter, and how worried are you? Or, I don't ask people to time the market, but looking forward 2021, 2022, have you hedged for that just in case scenario? And if so, how?
One of the greatest speakers that also used to appear at Cambridge House had one of the greatest lines that I steal from him after 3 decades. Jimmy Dines, who used to say, think of the poor guy that invented preparation G. Obviously, it was preparation H that meant this. So timing is everything. I don't believe in market timing. I just think that one of the things that you always heard when I was both a money manager and then on the other side was, hey, you guys always tell us when to buy. You never tell us when to sell. But One of the things I learned is you really should start thinking about selling if you couldn't first buy today what you own. And that's where I think the general equity market is. Now, in terms of hedging, like I said, other than a crash, I'm not too concerned that my uranium holdings, things related to gold and silver, and also to copper will be hit other than that short-term draft. Now, I don't believe there's going to be this crash like we've seen in the past, where suddenly we're down 20, 30% in a day. There were mechanisms not involved back then that allow that, will kind of curtail that. But I do think we can fall 20, 30, even 40% over time. If it's over time, I'm really not going to worry about my particular holdings because people won't have this liquidity crisis. But like you said, if there is a liquidity crisis, there are ways of hedging. The ultimate way is futures, which I think is the most risk. And I used to joke, with no disrespect to some good people in there, I used to walk up to the futures and option guys and say, here's my wallet, give me half and take it back and promise you won't take my call. So I'm not a big futures believer, but options do have a way of being used to hedge. And if you have a large general equity portfolio, maybe that's what you need to do. But I also have to say, Jay, that the market isn't anything what it used to be when I started. And if you like, I'll expand on that.
Please do, yeah.
So when I started 37 years ago, 90% of the trading was the general public, and most people were treating it as a market was originally intended to be a place to go and be part ownership in a business. You bought stock because you thought the company would have a new product or expand a service. It would increase the value of your ownership. Somebody would come along and pay you higher, and they thought it would continue to go on and on. Markets are almost nothing like that. First, one of the biggest changes, about half of all money in the U.S. equity market right now is in passive funds. This is money that's basically set aside. It's not being actively managed. The manager is not making decisions. He says, should he sell IBM? Should he go along this oil stock or what have you? He's simply, or she's required to follow an index. So that money is not what used to be active. Now we're left with the remaining half. And that's basically being driven by computer programs, whether it's algo traders on headlines based on just words that are used, or sophisticated programs with gamma and shorting futures and being long, what have you. And so we first have to appreciate that the market isn't what it was. So when I see people my age still using fundamental analysis from 30 years ago, I think they're outdated. I think you have to understand what I just explained. Now, the other factor is, given what's happened in the last year, we had about 10% of the Americans did okay, and the 1% did really, really good. But the vast majority of people either held their own, fell back, or lost everything. Now, there's only three things that can happen, Jay. These guys catch up to this group falls back to this group, or they kind of meet somewhere in between. The difficulty is, I tell younger folks, you need to watch the movie 2001 Space Odyssey. And they go, what's that? And I say, basically, the whole thing comes down to is the machines take over. And so the biggest concern I have is that one day, as much as machines and algorithms and everything have enhanced the market going up, they could become a deterrent that make it go lower than it needs to be. But I think the biggest single driving point is to understand that fundamental analysis, even technical analysis to some degree from 30 or even 20 years ago, is really outdated. It's really useless. And if you don't understand that and the parameters that are making up the market these days, you're really asking for trouble.
Right. Okay. Now I want to sort of jump onto that theme. What do you make of the surge in retail investors? I mean, and the very recent retail investors on the backs of Robinhood and various other discount online brokerages. I could speculate maybe spending stimulus checks. Not all. That's a generalization and probably not completely accurate. But, they're piling into a remarkably overbought equities market, Peter. What are your thoughts there? Is this good in the sense that there's a few million people who are suddenly turning their attention towards their financial future? Maybe it's more risk than they should be taking on, or is this just reckless speculation and it's completely decoupled from what matters and value, et cetera? What are your thoughts?
So you'll need to understand the minimum of a crap game, but I'll make it in a very short view. There's a game dice in a casino. And even though the odds are basically even whether you bet on the guy throwing the dice or against them, most people always bet with the guy shooting. It's more fun. It's kind of like the guys that are betting against him are shorters. You can only make a certain amount. Here you have this dream of, beating the casino and making a lot of money. Every once in a while, not often enough for anybody should go out and try to make a living doing this, but every once in a while, the game becomes what they call hot. The thrower makes all the numbers and never throws a 7, which kind of ends the game normally. And people have get to such a point where they bet so much and they keep increasing their bets and they become so camaraderie with each other. In fact, if you were a person that came over and made a negative bet, if they had a gun, they would shoot you. But they get to a point where they don't think they'll ever come to an end. I kind of feel that's where the market is coming. And as you said, not just the younger folks that have come in and maybe have only traded for the last 6 or 12 months, but even professionals that have been around for a while. But there too, we have an issue. 2/3 of the financial advisors in the States have only been in the business since after 2000. So they only experienced really one serious downturn. Almost 40% of financial advisors have only been in the business since 2010. So other than the pandemic fall of a few weeks, they've never experienced a down market. It's kind of like you learn to drive. You learn only to drive on a one-way street, And one day you got to approach a traffic circle. Now, I don't know if you remember the first time you got to a traffic circle, but I remember when I did, I was pretty scared. And I think that's what the market faces. It faces a combination of inexperience plus complacency, plus, as you said, a highly valued market that really has no room for failure. It's really being priced to perfection. And if for some reason that happens, or some reason the Fed can't keep creating trillions of dollars and keep artificially supporting the market, we're going to have a lot of inexperienced people, a lot of people that can't afford losses, that suddenly never even thought they could have losses. And they're going to hear that terrible word that you don't want to hear at a crap game, 7 out. And that's where the unknown is. Now, I don't know, Jay, is it tomorrow? Is it a year from now? But we're closer to it now than any other time. And the things, as you said, we've seen in the markets, the comments, the running up of $3 stocks to $400. Talking of a great new investment, and I don't want to get hate email because I only spoke about it once. I'm only using Bitcoin as an example. I'm not here to knock it or support it, but here we have it, just almost a unified opinion that it's going to go so much higher. And the real scary part is we have professionals talking about 400,000 and $1 million every day. Jay, when I was in the brokerage business, they threw guys and gals out of the business if you promised or talked about 20 times returns in a year or 3 years. And yet that's very common now. So there's a lot of excitement. It's that crap game atmosphere. And there's a belief that it can't end. And that's normally when it ends, when most people believe it can't. And we're very close to it. When we say close, it could still be, like I said, thousands of Dow points in several days or weeks or even months. But like I said, if you're not in by this point, it's certainly not a good time. And if you are in a big way, maybe it's time to look to take some of those chips off the table.
You know what? It's a really interesting bullet point that you mentioned, talking about the demographics of money managers in the US, specifically the age group and when they entered the market, therefore dictating what kind of experiences they've had, right? And largely it's been a bull market, right? The stocks go up. That's what the market does. It's kind of terrifying when you think about how flat-footed so many people could be caught in an inverse situation. Okay, now I want to jump into the 3 pillars as you identified when we began this call, being precious metals, the renewable energy trade. We can call that copper, nickel, and a few aluminum, a few others, and then uranium. So are you allocating capital right now, Peter? And if so, how and what kind of companies are you looking at?
Well, I bought all the uranium type stocks that I planned on. My first decision was a little bit different than others were advising. You still see, especially a lot of the public, and there's some good people on Twitter that speak about uranium that I follow, but they're very much into the early exploration companies. And while I think when uranium price actually does take off and go much higher than $40, anything uranium or almost anything will go up. I viewed the reason to own it was that supply dwindled, the need for nuclear energy was going to grow, and you can count on one hand, basically, the true producers that utilities can go and buy the uranium from tomorrow.
Yeah. Right.
Not a potential mine that may or may not be 3, 5, 7, or 10 years away. So my own self, focused on key producers, and one is just a household name, Cameco. That's a Canadian company, and then I used a couple of the ETFs that have several of the producers worldwide in them. And if and when we're right about suddenly the uranium price itself rising, which we haven't had yet, the stocks have risen, but the uranium price itself hasn't risen yet. But if and when that day comes, the major institutional people will kind of go the same route I did. They're not going to run right to the lower end and speculate on some, few penny uranium thing that needs a lot of money, a lot of drilling and all. They're going to go to the Camecos of the world first. When it matures and it becomes popular to everyone, then the second and third tier ones come. So on the uranium side, that's clearly how I want to focus. In the precious metals, I'm not as bullish on physical bullion because I'm not in the camp that I'm going to need gold or silver to survive some Armageddon or, get to my cabin in the woods, which from New Jersey is a long walk to the woods. But so the gains now, the leverage comes in producers. Reserves have fallen over 50% in the last decade. gold reserves. The majors are basically the top tier of merged who can merge with. There is going to be M&A still, I think, in the mid tiers because the 102 to 300,000 producers, they're having trouble growing. So the only way they're going to grow is to merge together. And then, of course, there's, the grassroots that a lot of people interested. Now, I chose, Jay, also that where you mine or look for metals is as important now than ever. 30 years ago, you can spin the world and maybe say, I don't want to go there and I don't want to go there. Now it's the opposite. Now you have to be really focused on where. So I ended up landing in a place I never really invested before, and that's Quebec. In fact, I believe there's a gold rush on the way in Quebec. There's a lot of juniors discovering a lot of worthy new prospects. So a lot of my investments are based there. But whether it was there or British Columbia or any other place in Canada or even a couple states in the US, I would want to be there before I would be in where I once was heavily invested, West Africa. Yeah. I think there's going to be troubles there, and it's already starting. So if you are looking at metals, it's as important where the company is as much as who they are, which always is key. Management separates winners from losers normally in the metals game. And of course, the type of metal you're looking for. I still think, as much as everybody's caught up in silver, I still think gold is the leader, silver second, but I'm very, very more interested now starting to buy copper plays and things related to the necessities for increased electricity.
Now, when it comes to copper, you touched on uranium, looking at developers and producers over explorers in the copper sector. Peter, are you looking at explorers or do you stick with producers?
Yeah, I have mixed in both. I've taken a very large position in an explorer out of Arizona, and I am looking at some of the copper ETFs. It's going to be very hard to turn it up and suddenly get a flow of copper back to where we first don't see a $4 or $5 copper price. And there, some of the juniors will do very well. But again, I think it's because of my age, Jay, and the fact that I lost more money in the metals and mining over 30-something years than I ever imagined I could even have. I tend to be more conservative now than playing the real grassroots. I tend to play as much as the significant producers and things that give me diversifications like ETFs and what have you, than I do roll the dice that I might have 20 or 30 years ago.
Okay. Yeah, I'm with you there. Yeah, and I'm seeing that across the board. Jurisdictional risk is at the forefront, and fewer countries are safe for investors, or at least preferable. Look, Peter, I really appreciate your time. It was so good having you on the show. It was about time we did this. So thank you so much.
Well, thank you. And thank you to Cambridge House. For 30 years, it was a significant part of my life. Wherever you are in different cities in Canada and down in the US, it was always a joy. And God bless your father. Please give him my regards. I'm sure he's watching. And he was one of the most joyous people to be around. And his son has taken it to another level. God bless you both.
Appreciate that, Peter. Thank you.
God bless.